There are two key concepts in price action trading that, when combined, form one of my go-to entry models. These two elements, liquidity and market structure, are fundamental to how I approach the markets. In this video, I'll break them down in detail and show you how to use them to develop a practical entry model that can help you find high-probability trade setups and potentially grow your profits. So let's dive in. Market structure theory is based on the idea that price moves through three main phases: uptrends, downtrends, and consolidation. An uptrend is when price consistently moves higher. In this phase, we aim to buy, not sell. A downtrend is the opposite, it's when price continues to move lower. During a downtrend, we focus on selling opportunities. Consolidation refers to sideways movement, where price lacks clear direction. These phases typically offer fewer high-quality trading opportunities, so we tend to avoid them and focus more on trending markets. To identify whether a market is trending up or down, we look at the highs and lows. In an uptrend, the market forms higher highs and higher lows. Each new high and low is higher than the previous one. These new highs are created through what we call a break of structure. When price pushes above a previous high, it confirms the continuation of the uptrend. Conversely, in a downtrend, we see lower lows and lower highs. Each break below a previous low is also a break of structure, but this time confirming the downward movement. A trending market consists of two types of movements: impulsive moves, strong movements in the direction of the trend. These are the ones that break previous structural levels. Corrective moves, temporary pullbacks that go against the trend and allow for new structure points to form, like higher lows in an uptrend or lower highs in a downtrend. For example, in an uptrend, price pushes up to create a higher high, impulse, then pulls back to form a higher low, correction, before another impulse resumes to break the new higher high. This cycle continues until something changes in the structure. Eventually, trends reverse. One way we can spot the early signs of a reversal is by monitoring the higher lows or lower highs. Let's say we're in a clear uptrend with strong bullish impulses and shallow corrections. If the market suddenly breaks below the most recent higher low, that's a signal that the uptrend might be ending. This break below the higher low is now considered a bearish impulse. From this point forward, we shift our bias. We now expect the market to start forming lower highs and lower lows, confirming the start of a downtrend. So overall, the structure transitions like this. First, we have bullish momentum, higher highs and higher lows. Then, we get a key break below a higher low, signaling a potential trend change. From there, the market begins to form lower highs and lower lows, marking the start of bearish price action. This structure-based view of market behavior is a powerful tool that helps traders make informed decisions. Most of the time, markets are trending in one direction or another. Only during consolidation do things become unclear, and those are the times we prefer to stay out. Now let's shift our focus to liquidity, a crucial concept in trading. At its core, liquidity refers to the presence of orders or capital in the market. Simply put, price moves because of the flow of buy and sell orders being executed. To grasp liquidity, think about this. Where are traders typically entering and exiting the market? Let's take a trending scenario. Imagine the market has printed a swing low and a swing high. These price points already exist on the chart, and we know that traders often react to them. There's typically buying interest around the lows and selling interest around the highs. This is true whether someone's trading based on support and resistance, supply and demand, or other strategies. Most retail traders will place buy orders near lows and sell orders near highs. And here's the key part: they almost always place their stop losses just beyond those levels. A buyer who enters near a swing low will often put a stop loss just below that low. A seller who enters near a swing high will typically place a stop just above that high. This behavior is extremely common, it's what most trading education teaches. And while it can work, it also creates clusters of stop orders around those key price levels. These zones are what we call liquidity pools. So when we mark out a recent swing high or swing low, we're also marking zones of liquidity. Why? Because beneath the low and above the high, there are likely to be thousands of pending orders, stop losses from traders, and in many cases, breakout orders as well. For example, Under a swing low, there might be both buy-side stop losses, from those who bought earlier, and sell stop entries, from breakout traders waiting to short if price breaks below. Above a swing high, you'll find sell-side stop losses and buy stop orders waiting to trigger on a breakout. These concentrations of orders create high liquidity zones. Now here's the critical insight. Markets are drawn to areas with high liquidity because that's where large volumes of transactions can take place. Price isn't likely to respond strongly in the middle of a range where there are fewer orders. But when price reaches one of these liquidity zones above highs or below lows, we often see sharp reactions. That could look like price sweeping above a swing high and then sharply reversing downward. Price dipping below a swing low and then bouncing aggressively upward. This is the foundation of liquidity-based trading. The market hunts areas where large numbers of stop losses and pending orders are located, then uses those orders to fuel the next move. Now let's go a step further. Suppose we're looking at a market that just completed a bearish move, followed by the formation of equal highs and equal lows. From a classical supply and demand perspective, this looks like a clean range, supply at the top, demand at the bottom. Now think about what traders are likely to do here. Most beginners, and even many experienced traders, will try to buy at demand and sell at supply, using these levels to frame their trades. But what does that mean for liquidity? Exactly what we discussed earlier. Buy orders will stack just above demand, with stop losses right below. Sell orders will gather below supply, with stop losses just above. As a result, the supply and demand zones now double as liquidity traps, zones where the market might deliberately push beyond the level to trigger stops and grab liquidity before reversing or continuing. So here's what typically happens. Traders place buy orders near demand, expecting the market to bounce and move higher. Likewise, they place sell orders just below supply, hoping the price will reverse downward from that level. From this behavior, we can understand where stop losses will likely be concentrated. Below demand, we'll find stop losses from buyers who want protection in case the market drops. Above supply, we'll find stop losses from sellers guarding against a breakout. And that's not all. We also have pending breakout orders, what we call buy stops and sell stops. Above the highs, there are buy stops placed by breakout traders anticipating a continuation upward. Below the lows, there are sell stops placed by traders expecting a breakout downward, often looking for a break and retest scenario. Now, while many traders who study advanced price action may ignore these basic strategies, it's important to recognize that a huge number of traders around the world still trade using supply and demand, and similar classic concepts. So the liquidity builds up heavily in these areas. Let's ask the important question again: where is the liquidity located? It's not sitting randomly in the middle of the range. It's found at the extremes above the swing highs and below the swing lows. That's where the largest concentration of pending orders typically sits, and where price is most likely to react significantly. So what does this mean for us as traders? We watch for the market to take out one of these key levels, either the high or the low, and then we start looking for a trading opportunity. If the low gets swept, we watch for signs of a reversal and prepare to take a long trade upward. If the high gets swept, we look for signs of rejection and possible short setups. What's powerful about understanding liquidity is that it helps us with two key trading elements. If we anticipate that the market will go after the next liquidity zone, like the next swing high or low, then we can use those levels as profit targets. For example, if price sweeps a swing low and then begins to reverse, we could aim to ride that reversal up to the next swing high, anticipating that the market wants to clear out the liquidity sitting there as well. When the market moves into a liquidity zone and sweeps it, that's often followed by a shift in market structure, such as a change from higher highs to lower lows or vice versa. That shift gives us entry confirmation. Let's visualize it with an example. Imagine a bearish trend. We've got clear impulsive drops followed by smaller corrective pullbacks. In this context, the market is forming consistent lower highs and lower lows. Now, somewhere during this sequence, we spot a set of equal highs, creating a visible supply level. At this supply, we know liquidity is building, stop losses from sellers, buy stops from breakout traders, all stacked just above that level. When the market pushes above those equal highs, it sweeps the liquidity sitting there. That's our signal to pay attention. If we now see the market shift structure, breaking down from forming higher highs and higher lows into forming lower highs and lower lows, that's a high probability entry point to go short. Our target: the next visible liquidity zone below. And just like that, you're starting to see how a powerful trading model is formed, structure and liquidity combined into a clean, effective entry system. There are times when this setup unfolds within the context of a bearish trend, and when it does, it can be one of the highest probability entries available. When the market pushes above those equal highs or resistance, it taps into the liquidity sitting just beyond them, stop losses and breakout by orders. That's the trap. Now here's where we apply one more powerful concept: supply and demand. In this case, we look for a supply zone, which is a price area just before a strong downward move occurred in the past. This zone tells us where strong selling pressure previously entered the market. When price returns to this level, it's seen as a premium price for sellers. So once the market runs the liquidity above the equal highs and enters the supply zone, we look for a sell opportunity from that area. Why? Because it's a historically significant level where large sellers are likely to step in again. This setup can be used across all time frames, and even if it feels a bit abstract now, it will become much clearer when we walk through real chart examples. Common question: isn't that a break of structure? You might be wondering, if price breaks above a previous high, isn't that technically a bullish shift? And if so, shouldn't we be looking to buy instead of sell? Here's the key: not all breaks of structure are true reversals. When a break happens above equal highs or a well-defined resistance, that area is stacked with liquidity, stop losses from sellers and buy stops from breakout traders. Often, the market will temporarily break above these levels not to start a new trend, but to trigger those orders, collecting liquidity before resuming the original trend. So while on the surface it might look like a break of structure, it's actually more of a liquidity sweep. However, if there were no equal highs, no significant liquidity, and the break occurred in a more natural trending movement, then yes, we could more confidently treat that as a true break of structure and look for continuation buys. When trying to decide if it's a genuine break of structure or just a liquidity sweep, ask yourself: is there a major liquidity pool like equal highs, a double top, or resistance just above? If yes, it's likely a liquidity grab before continuation in the original direction. If no, more likely a real structure shift that could lead to a trend reversal. This awareness allows you to avoid false breakouts and position yourself on the right side of the market. Let's break down this entry model on a real chart. We start with a clear bullish trend: higher highs and higher lows are forming. But right after this shift, price action becomes a bit choppy, a sideways consolidation phase. And as we've discussed, consolidations are typically not great for trading on their own. However, they set the stage for something more valuable: liquidity buildup. During this range, you'll notice multiple rejections at a similar level, creating what we call equal highs and equal lows. These areas act as supply and demand, and more importantly, they hold liquidity, stop losses and breakout by orders and sell orders from traders expecting a bullish breakout or bearish breakout. This is where the trap is set. Now we bring in the final piece, the FVG zone. So what do we expect? We want to see the market push down, sweep the equal lows, grabbing liquidity, enter the FVG zone, then show signs of bullish rejection. So whether you're going long or short, the structure plus liquidity plus zone model works both ways. It's all about recognizing the context. Turn this entry model into a full strategy, backtest it, journal and validate it, and finally trade it with real confidence. Having a solid system is the difference between guessing and winning. Thanks for watching, and I'll see you in the next video.